Hey guys. So I'd like to start by Paul's used to coming to these conferences with his massive TVL and feeling like he's the man in the room, but he's the little guy on this stage. We've got $100 billion of AUM represented by the Bpifrance. I don't think we need a huge introduction there. I was told last night that Ivan is pretty much the sole reason BPI does crypto, which we can see from his shirt if you can. And then we have Christine on his left, representing, I think, what was it, 750 billion?
That's right.
You call this AUM.
Just close to $1 trillion.
Yeah, AUM in real people speak. And no introduction needed for Chris. Chris running Plume, Plume smashing it on the RWA focus, L1. I think the first thing I want to kind of get into here is we don't have a huge amount of time, and I really want to get some good insights out of each one of you, given the kind of the talent we've got here on this panel. And so I want to start with you, Christine. So we were talking earlier, so you've worked in the RWA space, if you want to call it that, in the industry in quite a number of years. You've got A-Cred on Morpho. Check it out if you've not yet. It's yielding 8.5%. This is really interesting because right now Athena is yielding about 1.2% because the perp yield's completely collapsed on the exchanges. So clearly diversity in yield-bearing products is a necessity. What products do you see evolving in this space?
Yeah, sure. So really excited to be here. Thank you for inviting me. So as mentioned, I'm Christine. I'm from Apollo, which is a $750 billion asset manager with businesses in credit, equities, real estate, and infrastructure. And yeah, I mean, Alex, as you mentioned, it's been my life's work, I guess, working on the tokenization of real-world assets. Previous to joining Apollo 3 years ago, I built and led JP Morgan's blockchain program. So if you've heard anything about JP Morgan tokenizing $2 trillion, a little bit over the $2 trillion of treasuries and US dollars on a permissioned Ethereum blockchain, I led that work. And in fact, last week you heard about JPMD, JP Morgan Depository Coin on Base. I invented JP Morgan Coin back in 2017 when we actually thought that maybe JP Morgan could issue a stable coin. So, when you ask me like what products are next, I've literally worked on or thought about or prototyped every different product in TradFi in terms of, what's possible, what's technically possible. I think the real question is, where is there investor demand right now? And, I think with some of the private credit tokenization work that we are seeing, that we started, but basically this January, we're going to talk a little bit about that. You mentioned, the fund that we tokenized. I think what we're seeing is almost like infinite demand for yielding assets, because essentially we're talking about a $3.5 trillion market, a few hundred billion in stable coins. We're seeing a migration from stablecoins to, the 4.5% yielding treasury. So maybe call it like, 8 billion or so of that. And then, certainly there's a lot of on-chain credit, but then now, we have some of like the institutional private credit that Apollo is putting on chain. But I think what we're seeing is that there actually is demand for a spectrum of yield. So the fund that we tokenize is sort of like right down the fairway in terms of yield and liquidity profile. But in reality, as you see stable coins moving on chain, they will all increasingly become yield seeking. Essentially, what we are doing is rebuilding, or challenging almost the bank deposit system. And so, where you can think of treasuries as sort of, kind of close, your stable coins and treasuries in combination as your checking. Having higher yielding assets is sort of where, I think we're building crypto savings. And so, at Apollo, we're really well positioned to create that tokenized yield that is diversified away from the crypto ecosystem. Basically of the 750 billion that we have, 650 billion of that is credit, so all yielding assets. We have owned or invested in at least 16 different companies that generate different types of yielding products from, mortgages, to aviation leases, to trade receivables financing, to direct loans to companies. Like, for example, we lent Intel $11 billion to build out AI factories. That's the kind of stuff that we'd like to bring on chain, and that we think that there's a significant appetite for.
So there was one thing that made me smile in the reply there. I think there's going to be a lot of stablecoin issuers getting very sweaty about their lack of banking license when you mentioned bank deposits there in that reply.
Well, that's sort of where we, sort of get to the Morpho conversation. I mean, do you want to talk about, how you can convert the stables into yielding assets?
Does that work now? Let's go. Okay, so for those that are not familiar with Morpho, so Morpho is a lending and borrowing protocol on EVM. We're the second largest with $7 billion of assets deposited into it. We have the chance to be deployed on many different chains, including Plume very recently. Morpho is capable of tailoring to any risk or compliance profile, notably thanks to Keyring. Does that work now? Yeah. Let's go. So,
said Keyring.
We have the chance to be backed by amazing investors such as BPI. and on Morpho, you can have a wide variety of assets as collateral, including credit funds such as the Apollo, like ACRED, that has been tokenized and available to borrow USDC with it as a collateral. So essentially, all those stablecoins that you were saying, like, are now building their own lending vaults. That are operated by vault managers or curators. I see some of them in the room right now. Essentially, the idea is that it's a non-chain asset management protocol where lenders are going to deposit their capital, and then on the other side of the trade, you have people borrowing those assets and paying yields with some crypto as collateral or tokenized assets as collateral. Initially, it was mostly crypto-backed loans, but over the years, we sort of capped that market, at least in the DeFi space, and more it's becoming real-world assets as collateral, right? So we have the pleasure to work with a lot of different real-world asset issuers to enable some leverage on some of their real-world assets, but also as some players bring on for example, tokenized securities, etc. We could also imagine having stocks as collateral and build perpetual on top of lending primitives, etc., etc. So there's a wide variety of things you can build on Morpho.
Yeah, I think I want to drill back into the particularly around the kind of liquidity thing in a moment later on. But first, I want to come to our friend Ivan from BPI, and. Now, I don't know if many people know, but the BPI, I think, is probably the first significant financial institution to take DeFi tokens onto its balance sheet, which is a huge step forwards, taking positions in Morpho's Blue and some others in the crypto ecosystem, particularly around decentralized finance. How do you see, why are more people not doing this? And why do you guys take that particular step yourselves?
Thanks for this great question. So first, most people don't know about tokens, and that's a problem. And especially in Europe, when you don't know something, you're not brave enough to tell it. So you kind of ignore it and say that crypto is for financing terrorists and stuff. So you have to go through this barrier first of saying, no, this is super interesting, and this might be the future of finance and the future of France. And so it's a psychological barrier first. And then you have the regulatory one. The good news is that now we have a European ruling called MiCA, so a full crypto framework. So then when you survive to these two barriers and you didn't quit your big organization, then you can begin to work with very serious projects and see that at the end it's another way to do finance, it's another infrastructure, and the great news is that we globally at Bpifrance are learning so much because we have experience of TradFi processes and we can clearly see what points are improving with DeFi. So on-chain instant settlement, real-time exposure to risk. So we're very excited. And to come back to Monique's point, we are monitoring 30 tokenization use case. We don't know which one will explode first, but we're very excited because you can use tokenization on the asset side and on the liability side. So very excited to be here, and the stablecoin Cambrian explosion, I hope, will be the first step of a great movement.
Yeah.
And if I could just add, like, I mean, I think, you know, since both you and I sort of represent the traditional financial institution point of view, it's quite interesting in that, you know, you were talking about how investing in tokens, like it's almost like a mindset shift, and you have to, you know, sort of create a new practice of investing, right? Because token economics and, you know, how you underwrite a token deal is quite different than how you would underwrite like a typical equity deal or a credit deal. And so what's interesting is that from the point of view of a traditional investor, if you will, you know, we are, you know, now sort of undertaking new types of underwriting with tokens, investing in crypto. We are now seeing new areas of distribution. This is, say, for example, the fund tokenization, and, you know, being able to reach a next generation of on-chain crypto investors. And then, you know, we also are opening up a new category, especially for someone like Apollo, that, you know, literally, like, we are I guess, in real life, like, borrow-lend protocol, if you will. Like, that's our business. And, like, so, you know, we do, like real-life borrow-lend, and then now needing to learn about on-chain borrow-lend and how do we participate that appropriately and compliantly and actively and in size the way that we do. So at least from my point of view, there's literally like 3 vectors of change: investing, distribution, and actually like borrowing and lending, which happen to be like, you know, the 3 most important parts of like our business, right? And so, you know, it's kind of interesting, you know, sort of being on the leading edge of figuring this out. And, you know, it will be kind of interesting to see how some of the other asset managers, you know, end up adopting and picking up, you know, with us. But, you know, it's quite revolutionary in terms of like what we're going through in this moment. It's exciting. I like it. But, you know, it's obviously will cause a lot of chaos.
Well, I think if you look at the macro fund returns in the last couple of years, there's been one, I don't necessarily want to name them per se, but I think we all know there's been one macro fund in the fixed income space which has outperformed all the others from their tiny allocation to the crypto industry. And I think we will see the same from the Apollo side. So I just want to come to you, Chris. You've been a bit quiet in the corner, so I want to kind of pick on you for a moment.
A little hungover, to be honest.
So what we noticed, and I think we shared this with you recently, we noticed that there's been effectively the DeFi space has been following exactly the same adoption pattern, product by product, as traditional finance. When you look at each of the major blow-ups of, like, in a good way, of traditional finance, all the way through from insurance, through money lending, money creation, it's all happening in the exact same order in DeFi. What I'd be really interested to hear about is if we're kind of on the cusp of kind of the modernization of DeFi, what are the next products that you look at in Plume? Because obviously it's very important that you align yourself with the correct product suite, as it were, to kind of bolster your real-world asset adoption plans.
Yeah, totally. One, thanks for having us, and great to be here with a bunch of friends. I mean, obviously we work with Paul of Morpho. Christine's one of our investors at the A as well, and of course, soon to be with these guys as well then. So it'll be great. But look, I always think RWAs is a tricky conversation because it's very easy to mask what's going on with big numbers. You know, it's very easy for people to kind of forget what's really happening, right? At the end of the day, right, we're talking about not only changing the nature of these products, but also finding a new market. That's always how I thought about this thing. At the end of the day, you're distributing a product to a new set of people in a new manner. Right? And so I think the basis for us has always been at Plume to start and thinking about RWAs from a crypto native perspective, which is how do you mold these products and bring these products to a crypto native audience and begin to see actual adoption there. And from there, then you can sort of find the truth and begin to build the next set of things, right? And so if you look today, you know, there are 2 ways to sort of measure adoption. One is you could look at dollars on chain. Right? And so there, everyone knows that chart that goes up to the right? The $20 billion or whatever, right? Of which half is one company, Provenance, right? Number 2, right? The other way you can look is by number of holders, right? And so we focus on the latter, right? Because I think, look, if you have, 13 wallets all by the same person, that's one way to do it. And the second way is you can have a lot of holders. And so we've been on it for 3 or 4 weeks now. Now we have over 100,000 holders, and the #1 chain by number of RWA holders. And so to me, if you want to start there, that's where you start. You got to look at what people are doing and what people are there, and the products evolve and change from that audience, right? I actually don't think it's a parallel to TradFi. I do think it's followed a similar path, but more as a function, more as an accident, and more as as what's going on. To me, the reason why yield products are popular right now is because on chain there's only so many things you can do, right? Like, what do people do on chain today? There are 3 things, right? You yield farm, right? You speculate, and you do spot, right? You trade. Right? And so like those are kind of the sort of things, which is like buy, trade, lend, borrow, right? So those are the things people do today. And so naturally, the products that have gotten more adoption fit those profiles, right? And so that's where it's starting today, right? Where it's going, it's hard to say, because as the audience changes, right, on chain, and right now we're finally seeing, new people come in through new means, right? I think the stablecoins bringing new people in. You have people in emerging markets coming in. There are many reasons why people are coming in now. And as that audience changes, the things they want will change, which means the nature of the protocols and types of products will change as well. So today, look, it's a bunch of people on chain trying to do degen stuff and trying to earn yield. So of course, yield products are where they're at, right? And of course, yield naturally leads itself to more DeFi products, because you're going to want juicier yield, you want leverage, and crypto, we like leverage, right? And but again, we'll see where things go from there. And I think it's an exciting time because it's an introduction across multiple vectors. You have geographies, age groups, right? And sort of as regulation changes, you bring a new class of people in as well. So I think it's the first time you have this really broad swath of new people from different vectors that are going to come together, and we'll see what products come out of there from there.
No, it's a really good point, and I think the yield aspect is definitely a critical one. We've seen a lot of the products which are particularly high yielding do very, very well, and this is again the same with ACRED side. I want to touch on something you mentioned there on the stable thing, and this is kind of more to the Frenchies in the panel. So we're all aware from the kind of the other side of the pond situation, there is a big elephant in the room when it comes to currencies on chain. And I think we've looked at this recently, and we were talking to someone about why is the reason for that. And I think one of the main reasons that we were investigating is it's basically the continuation of the Eurodollar market, but in the DeFi format. And one of the big issues with the with effectively non-dollar denominated currencies is the sovereign bond liquidity is just not there. What are you guys thinking about that from the BPI perspective? Because obviously the euro is the second most liquid currency in the world and represents less than 1%, literally less than 0.1% of DeFi and crypto.
It's a very good question, because Europe right now, big news, has a huge project called Savings Union.
What's it called?
Savings Union.
Savings Union.
So it's
Sexy.
kind of a socialist and capitalist name. I mean, it's funny. And the not funny part is that how inefficient the European bond market is.
The bond market, right?
Yes.
Yeah, the fragmentation.
The fragmentation and the fear of securitization. Because of the GFC, when you talk about securitization in a European bank, everybody is very afraid of you. With on-chain settlement and CLOs, first, we can solve a lot of these problems about loan transparency and real exposure. But to be really blunt, this is too advanced for the UCB and European Commission. So we might miss a very important step of more transparency on financial institutions and stuff. And on the other hand, the joker of the European Commission is a CBDC. And the problem we have, it's not live. I don't know what it will be.
Will never be live, is the
29,
question.
I've heard.
And it will be IBM consultant that will work on this. I have nothing against IBM, I worked there, but I wouldn't trust them, and I would trust more of my colleagues here. So it's a huge challenge, and let's take the bet of talking again about this in 5 years and see the results.
So one of your main takeaways I'm getting from that is basically something that's been a huge problem in the European market since day one, which I think George Soros took a big advantage of when the first peg against the Deutschmark was the lack of a issuance market, a consistent issuance market. So that brings us to liquidity.
Wait, can I just add a comment on that? I mean, I guess
sure.
one of the superpowers for blockchains that I think is not ever really well discussed is that by bringing assets onto a blockchain, you are essentially bringing disparate asset types from different places onto the same operating system and then making them programmable, which, you know, I think addresses some of, like, potentially addresses some of your observations around fragmentation. Everybody always talks about atomic settlement and T0. No one really cares. Like, I don't think anyone really needs that, right? Like, you know, you actually need a couple days to enable liquidity. If everything was atomic, then, you know, you just wouldn't have, like, fluid markets. So, you know, everyone talks about cost savings, but in reality, like, cost savings use cases don't really, you know, accelerate in any direction based on my 13 years of experience. But what I do think is very powerful is this idea of bringing multiple different asset classes together on the same operating system. So funds, equities, fixed income, crypto, dollars, euros, all together in one system. And by the way, the interesting thing is it doesn't even matter if it was natively born on blockchain or if it was, you know, kind of tokenized as in like put in custody and immobilized and then created a digital twin. It doesn't even matter. Like, it even uniforms like that. And, you know, I think when we saw like the Robinhood announcement yesterday, like bringing in US equities to European markets, you kind of just see that these assets that were typically trapped in different, say, geographical pockets, or these currencies that were trapped in different geographical pockets or legacy systems, are potentially just going to get unlocked onto the same operating system and, you know, programmable, which, you know, like, as you know, software is quite scalable. You know, we spent a lot of time thinking about this. We wrote a paper 2 years ago with the Monetary Authority of Singapore around how once you have all these different assets, dollars, treasuries, equities, ETFs, private markets, that's a whole setup for a total portfolio, a total investment portfolio. And smart contracts, I think what we've learned in DeFi is like most like used for like rebalancing pools of different assets, all right? Like, I mean, usually those assets are different types of stable coins or, you know, different types of wrapped crypto with stables. But now that we have the emergence of these quote unquote real world assets, you can certainly see how one day, like, each of us will have like a specifically customized model portfolio for our, you know, savings and retirement needs. I know nobody in crypto really thinking about retirement yet. I don't know, unless we're all like retiring early with our crypto gains. But like, you know, that we have like model investment portfolios that are designed specifically for when we want to retire, for our earnings, you know, for our risk profile, and that smart contracts just automatically maintain that for us. Like, we generate income.
I want to
And it's happening already. I mean, like to this point, on Nest today, right, on our protocol, right, and of course, I'm a relentless Plume shill, so you have to apologize for me. But like, if you look at today, we, you know, most of these RWAs are like, people just tend to talk about T-bills. Right, it tends to be T-bills, and now a lot of private credit. God bless, we're beginning to diversify away from just T-bills, right? We have a little bit of CLOs as well, so it's coming to play. If you look at Nest today and look at Plume today, right, our focus has always been, let's have every asset on here at the same time, right? Just like Christine said, right? Let's have everything on here, ranging from, you know, we've got things like camel farms, we've got things like, you know, durian farms, all the way to financial instruments, right?
Oil,
like
all the way
all on the same operating system.
Exactly. And
like,
so,
even allowing like assets that weren't ever
right.
even like coming to the surface, really.
That's right, exactly. And so if you look at like Take Nest, we have a protocol called Nest, right, where you can bundle these things together and create these sort of like customized ETFs. And the initial ones are sort of more large, medium, small, packaged up. But take N-Alpha, which is one of our products today that has a bunch of stuff in there. You've got ETFs, right? You've got yield-bearing ETFs. You've got CLOs in there. You've got private credit. You've got wrap BTC. We've got the basis trade. And you've also got things like Mineral Vault, right? Which is you know, it's like a new thing. It's oil royalties in the U.S., right? So you've got over 3,000 producing oil wells in the U.S. that just spit off cash, right? It does one thing. It sits there and turns, you know, oil into money, right? And like, in America today, right, it's a highly coveted thing, but only a certain set of people. So there's 600,000 holders of that asset in America. That's it, right? In just 3 weeks, right, we've got over 60,000 on chain already, right? So over 10% of the holders now are all over the world in tiny increments. You can do $1 into this thing versus. So like it's beginning to happen now. And now today it's a little bit more, pre-packaged than not. And we're working with, again, many of the curators are here to kind of put these together. But they, like Christine said, it's very clear to see, not even in the future, like very soon, this will all be done automatically and sort of custom, built for each.
And the way that it works, like a pool that has, $50 has the same, sort of mechanics as a pool that has $50 million, right? Like technologically it scales, right, from your experience.
Yeah, so the hurdle to entry is exceptionally low. And I think what's really interesting is I want to come back to what Christine said and some of the points that you were touching on there, is the ability, and this we were talking about this the other day actually, Christine, is the ability to effectively use something like Apollo's fund as like a proxy, almost like as a savings account or a retirement fund. And what a product like Morpho allows you to do is effectively, I mean, you can think of an extreme example. You might take your entire salary and buy, say, ACRED, and then borrow dollars against it for your living expenses and just pay like the yield difference. And you're making basically like an arbitrage on that. And I think a lot of people are doing that currently on Morpho. But that brings me to the kind of the risks associated with that and the kind of like the liquidation aspects. What happens when these assets start to look at a bit, what happens when we have a stress scenario? What happens when there's a stressed market event on chain? How do people get out of these positions and how do liquidations work?
Right, so maybe like 2 seconds lesson, like our collateralized lending in general. So the way it works is you deposit some collateral to borrow assets, and if the price of your collateral goes down, then it gets liquidated. And so a liquidator has to repay the loan, take the collateral, and sell it, right? And so the big question is like, how do you sell it and at what price, right? When you're doing like fully on-chain crypto native loans, well, the way it works is that you would go to Uniswap and you would sell and you would hope that the slippage that you get out of it is enough such that you're profitable liquidating, right? But what we're seeing now is that we have interoperability with traditional financial systems and backends because we're tokenizing assets and we use them as collateral. So what's interesting is that we're seeing like some players, like the liquidators, quote unquote, that are integrating both with TradFi backends and DeFi backend and sort of merging the two where when they want to like redeem like a real world asset in like the real world, they actually have to connect to the account with like the TradFi backend, redeem the asset, etc., to be able to repay the position and sell the collateral. And what's interesting is that this is how it starts, but over time, liquidity starts to build on-chain directly, right? And so instead of like going to the primary issuance in order to repay the loan and seize the collateral and sell it, etc., you're gonna see more and more like those secondary markets on-chain being more and more active and attracting more and more of the volume in order to be able to liquidate. And then what happens next is like, okay, no one is really like using primary issuance anymore on the TradFi backend. Why don't we move the entire TradFi backend into a decentralized like backend, right? How do we stop tokenizing like funds that are run off-chain to benefit from on-chain distribution to funds that are run on-chain with on-chain distribution, which is how things should be eventually, right? So we're starting with tokenization, but eventually we will operate the funds themselves. And as Christine said, like once we'll have all those assets like, created on-chain, like portfolio management will happen on-chain, like money market funds will aggregate bonds that are natively issued on-chains, etc. So there are a couple of regulatory blockers to get there, but that's definitely like the most optimal like way to build like financial services of the future, one in which you benefit from all the things we've discussed, most importantly being the network effects, I think, as we discussed.
Well, I think like for what you're saying, a huge unlock, and maybe our friend Ivan here can just hustle people up in the European Union to do this, would be native issuance of bonds on chain.
Yes,
if you had sovereign bond issuance on chain, that would be a complete game changer.
Soon.
We had these opinions are personal. We had great discussions with people from Banque de France and European Central Bank, and our message is super clear: is put some central bank money on a permissionless blockchain and do a system with the banks that can distribute this money. So basically replicate the wholesale retail model. And Content Network is working on this. It might be a solution, but there are others. But it's like a religious problem. like they can't do this because it's like, you know, the Catholics and the Baptists and the Reform. And the problem is that we have a good view on history. The Pope never converted. And if you read carefully the notes from the BIS about crypto, it's very violent. They're talking about containment strategy. They're not talking about innovation. They're not talking about financial democracy or anything. It's very, very negative. And we expect a cycle, and I'm not a big fan, but I must say that the administration in US did an amazing job about opening the box and having open discussions about the Genius Act, the Clarity Act. And Europe, unfortunately, is really out of the loop.
It's almost tongue-in-cheek when they call it genius, because it is absolutely genius. They're literally backdooring the entire emerging market of the BRICS countries and flooding them with T-bills. They've just found the biggest buyer for treasuries globally outside of the G7. And the European Union are just sitting there doing nothing, right? So we've not got it.
Just to add on tokenized bonds, like, so, I mean, one of the first things I think I did in 2016 was tokenize a bond, right? And so, like, technologically, it's certainly possible. And by the way, we did it so janky, like we did it so tradfi, like we built like global holiday calendars, like on the block.
Don't talk about holiday calendars.
Smart contracts.
We'd be here all day.
Literally, like we were like, how do we count days, like with a smart contract on a blockchain that doesn't have a calendar? Like that was how early days we were. This was before DeFi, so like literally the idea of like we're just counting in blocks and like we're accruing in like minutes or seconds, like definitely did not occur to us back in like 2016 to 2017. So I mean, I think my take on bonds is that, you know, the bond market is an all institutional market. And I think what we've observed is that it's the institutions that are taking quite a long time, I mean, us excluded, but like are taking a long time to get on blockchain, and it really is a network effects thing, right? Like for the many occasions in which I've tokenized a bond since that 2016 time, I think I've done it like every year since, like literally it's like one bond hanging out there and it like lives until term, like that was like a 1-year bond, we did another 1-year bond the next year, like they hang out there, but like in reality, if you don't have everybody there to do something with the bond and there aren't any other bonds, nobody's gonna be there, like you don't have the network effects to really drive that market. And so I'm not sure at this point, and also, sorry, like just to add on, like when we did the work to productionize that, that effort, there just wasn't really a business case. Like essentially like banks and institutions had spent decades like optimizing like how their cost structure for how they do public equities and fixed income already. So like again, cost efficiency. It was like, oh, like we could have.
It's very difficult to get the cost efficiency. So we have.
Anyway, the bottom line is
we are going to get kicked off stage in a second.
So the bottom line is, I'm not sure that the bond markets will come on chain the way that they exist today. But in reality, some of the on-chain lending that we see right now are the primitives for the next generation of bonds, and maybe over time the capital just flows into different sets of products.
So we are time's up on this, unfortunately, but I do want to get one quick hot take off everybody. How many basis points do you think the Fed are going to cut this year, starting Chris?
This year?
Yep.
By end of year? I'll just be optimistic. Let's do 100.
Okay, we got 100. Any bids?
I just have one message to asset allocators. Please bring more money into our great ecosystem. So if you know any asset allocators, let's go see.
Bring more what?
Money.
Money. Okay.
Bring more money, no basis points.
Yeah.
Next to Chris.
For me, you guys can all certainly subscribe to our Apollo economist, Torsten Slok. He does the Daily Spark and like has like macroeconomic views that you can subscribe to every day, and you get his latest thinking on rates.
Cool.
No idea about the basis points. I will say that eventually, once all the bonds will be traded on chain on Morpho, you'll be able to see in advance how, you know, what potential price the market is anticipating that the basis, like the difference of the Fed will be. So yeah.
Really exciting stuff. Thanks everyone for the time on the.
Thank you.